Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
Welcome to the deep dive.
Uh-huh.
Today, we are grabbing what can feel like a really dense, maybe overwhelming rule book for business finance.
Yeah, there's a lot there.
There is, and we're trying to distill it down,
Hmm.
into a single, clean, strategic roadmap.
Mm-hmm.
Maybe you're prepping for a meeting, maybe analyzing a competitor, or honestly, just curious about what really drives those big corporate decisions.
Right.
Whatever the reason, we're cutting through the noise today, focusing on the fundamental, specific, actionable steps, the things any business really has to look at to succeed financially.
And our source material today, it's crystal clear on the ultimate goal, isn't it?
It seems to be.
While businesses might have, many objectives, environmental targets, market dominance, whatever the primary financial mission, certainly for almost every private organization is stated explicitly.
Which is?
It is to maximize its profits.
Yeah.
Simple as that, fundamentally.
Okay. That's the mountain peak then. But as you start climbing, you realize there are really only two main ways up that mountain.
That's a good way to put it.
Okay, let's unpack this a bit. Profit maximization, it actually simplifies down.
Yeah.
Just two fundamental strategic levers.
Right.
And we're going to explore the specific, practical and sometimes pretty risky ways businesses pull those levers, all to drive that vital bottom line.
And that simplicity, I think, is what makes this material so powerful. Maximizing profits, that's the overarching financial goal, absolutely.
Yeah.
But, a manager can't just stare at the profit margin and wish it higher.
Yeah.
Right.
No, doesn't quite work like that.
They have to decide, are they going to focus on the top line or are they going to tackle the bottom line?
Precisely. And that decision, that gives us the entire structure for this deep dive today.
Mm-hmm.
Strategy 1, focus on the top line, increase revenue. Basically, get more money flowing into the business.
Okay.
Strategy 2, focus on the bottom line, decrease costs. You keep more of the money you already have coming in.
Right. Ideally both.
Ideally, you do both, yeah. But every specific action, every single tactic, it really falls into one of those two buckets.
Got it.
So now, let's dive into that first bucket, increasing revenue.
Okay.
We call these the growth levers, right? And this is often where, most of the excitement is. And maybe the risk, too.
Definitely the risk.
How does a company actually increase its sales? Our notes detail 4 distinct, quite specific strategies here.
And what's fascinating, I think, is that these aren't just vague suggestions like sell more.
No.
They're systemic approaches. They often require pretty significant initial investment, actually.
Mm-hmm.
But they promise sustainable, long-term expansion if they work. They are about truly expanding the pie, not just slicing it differently.
Okay, so the first way they hit that goal is the most classic one, just running promotions to increase sales volume.
Right.
Straightforward.
Yeah.
This is that immediate volume-driven lever. Think BOGO deals, temporary price cuts, maybe massive advertising campaigns.
Yeah.
It's direct, it's visible, and it's focused on pushing more units out the door, like right now.
But there's a catch, isn't there? If you rely only on promotions, you risk cutting your margins too deep. You give away too much.
Exactly. Which sort of naturally leads to the second strategy. This one focuses less on just volume, more on value,
Which is?
product development, or innovation.
Oh, R&D.
Right. The strategy dictates that if you invest in research and development R&D, that's the money spent making your product inherently better or maybe totally unique, then you can justify a higher price.
Or find new customers.
Or open an entirely new segment of the market. Exactly.
That's a fundamentally different approach, isn't it? Promotion feels like a sprint.
Yeah, definitely.
Well, innovation, that's more like a long-distance race, a big capital investment.
You're betting big on future returns, a real gamble sometimes.
Absolutely. The investment is capital intensive, no doubt. But the reward, if it pays off, is market leadership. Proprietary value that competitors can't just copy overnight.
Okay, that makes sense. Then the third strategy. This is one I think often gets overlooked, maybe until a business is in trouble.
Mm-hmm. Which one?
It connects directly to customer retention, improve customer service.
Ah, yes. Crucial.
And this isn't just, about smiling at customers. It's presented here as a measurable lever.
How so?
Well, our research shows that reducing customer churn, that's the rate, customers start buying from you, even by a small amount, say 5%.
Okay.
That can lead to profitability increases of up to 95%.
Wow. 95%. just from a 5% churn reduction.
That's what the numbers suggest. It's pretty staggering.
That number alone, I mean, that should make every single manager sit up and pay attention.
You'd think so.
Better service means higher retention. Higher retention means lower customer acquisition costs down the line. It's a virtuous cycle.
Right. It turns those sort of one-off transactional relationships into sticky relational ones.
Which acts as a powerful revenue driver over time. Absolutely.
Okay. And finally, strategy 4 for revenue. This one is about scope. Expand into new markets.
Going bigger.
Exactly. This could be geographic, taking your brand from one state or country to another. Or it could be demographic, finding an entirely new type of customer who hasn't seen your product yet.
This is the large-scale expansion play. It demands investment in new infrastructure, new logistics, maybe understanding completely new cultural demands.
Yeah, it sounds complex.
It is. It's probably the highest risk, highest reward growth lever we've discussed. Because you're literally betting that there's demand out there where none existed for you before.
Right. Big leap of faith.
Mm-hmm.
So, okay, recapping the growth side. We have promotion, innovation, service improvement, and expansion. Those are the key ways you try to maximize profit by driving that top-line revenue.
Nicely summarized. And now, we shift gears entirely.
Okay.
That brings us naturally to the other side of the profit equation. Path B, let's call them the efficiency levers.
Right. Keeping more of what comes in.
Exactly. This is all about decreasing costs. And this is often the focus for management, especially during, say, lean times.
Why, then, specifically?
Because every dollar, every single dollar saved here immediately drops to the bottom line. It becomes profit. It's often seen as an immediate win.
Ah, okay. Makes sense. Faster results sometimes.
Potentially, yes.
So before we dig into the strategies here, we probably need to clarify what we mean by costs. Because the manager's approach, it changes dramatically based on the type of expense.
Absolutely crucial distinction. We divide costs into two main categories.
Which are?
Fixed costs and variable costs.
Okay, fixed costs. Write
Yeah.
that down.
Think of it this way. Fixed costs are the expenses that, well, they hit your books every single month, pretty much regardless of how much you produce or sell.
Like the rent.
Exactly. The rent on your factory or office,
Yeah.
the insurance policy, maybe the long-term salaries of administrative staff.
Right.
They are, well, fixed commitments.
Got it. And variable costs.
Those are the expenses that fluctuate. They go up or down based on your activity level, your production volume.
So like materials.
Perfect example. If you make 100 units, you use X amount of raw material. If you make 200 units, you probably use close to 2X.
No.
Your variable costs, like ingredients, maybe some utility bills, delivery fees, they tend to move up and down right along with production or sales activity.
Right. That makes sense.
And this is why managers approach them differently. Reducing fixed costs,
Yeah.
that's notoriously difficult
Why is that?
because you're typically locked into long-term contracts or agreements.
Mm.
Our source material points specifically to two targets here: lowering rent
Okay.
and reducing insurance expenditure.
Okay, but reducing rent, I mean, that isn't like just turning down the thermostat, is it? You often have to make a pretty painful trade-off.
Such as,
Well, to drive that monthly rent down, maybe you have to sacrifice flexibility, like perhaps signing an unbreakable 10-year lease instead of a 3-year one.
exactly. That's a huge strategic commitment just to get a potential short-term cash saving. Big decision.
Yeah. And with insurance, why target that specifically?
Yeah,
It's essential.
It is essential. But businesses are often, let's say, overinsured. Or maybe their premiums don't reflect internal improvements they've made in safety or risk management.
So you can negotiate.
You can try. Reducing insurance costs often requires a kind of long-term internal campaign. You have to prove to the insurer that the actual risk profile of the business has genuinely lowered. Only then can you realistically renegotiate that fixed premium downwards.
Okay, so that distinction is crucial. Fixed cost reduction needs strategic negotiation, long-term commitment. It's tough.
Very, but variable costs.
Yeah.
Now that's where managers have real sort of day-to-day control and flexibility.
More levers to pull quickly.
Generally, yes.
Yeah.
And the sources provide 4 brilliant, very specific methods here for tackling variable costs.
Let's hear them.
Okay, the first 2 methods relate directly to procurement. That's just how you buy your supplies, your input.
Yeah.
1, simply finding cheaper suppliers. 2, achieving discounts through bulk buying. Buying more at once to get a lower unit price.
Right.
So just adjusting the scale or the source of your inputs gives you immediate, tangible cost control.
I hear you on that immediate control, but doesn't focusing too heavily on constantly finding cheaper suppliers, doesn't that inherently jeopardize the quality of the final product?
Oh, excellent point.
Seems like a massive risk to the brand, potentially.
It absolutely is, and that's the constant tension managers face. It's a balancing act. The key really is distinguishing between suppliers who are cheap because they cut corners
Yeah.
and suppliers who are simply more efficient, maybe due to their scale or their location
Yeah.
or better technology.
So it's not just cheapest, it's best value.
Exactly. A savvy manager isn't just seeking the cheapest input, they are seeking the best cost per quality ratio.
Mm.
And something like bulk buying, for instance, that usually has almost no quality risk, right? It's pure leverage based on volume.
Okay. Okay. That makes sense. Procurement is key.
Huh.
Now, what about the other two methods? These focus more on internal operations, you said.
That's right. Internal operational efficiency. Strategy 3, actively reducing waste in the production or operational process.
Waste. Like scrap metal in a factory.
That's the classic example, sure. But waste can be found everywhere, especially now. For a modern company, waste might be, inefficient software licensing, unused cloud storage subscriptions.
Ah, digital waste.
Exactly. Or maybe redundant steps in an administrative process. Just internal bloat. Cutting that is a direct profit gain. No downside usually.
Okay. And the final variable cost lever,
The final critical variable cost lever mentioned is targeting lower utility bills.
energy, water.
Right. This speaks directly to operational efficiency and resource consumption. It means everything from implementing energy-saving machinery, maybe installing better insulation, or just actively managing heating and cooling cycles more effectively.
So looking at the variable costs then, we have sourcing inputs more efficiently, suppliers, bulk buying and operating more efficiently, reducing waste, lowering utilities.
Precisely. And look, we connect this back to what we said earlier. Reducing these variable costs generally offers managers far more immediate flexibility than, say, trying to renegotiate a massive fixed commitment like a building lease.
Seems much more controllable day to day.
It often is, but
Yeah.
that raises an important question, maybe something for you, the listener, to consider.
Oh.
If those revenue strategies often require large, long-term investments, sometimes taking on debt, and cost-cutting offers more immediate results, maybe feel safer, which approach is inherently riskier for the long-term health of the company?
Riskier.
Is the risk of debt or failed innovation worse? Or is the risk of alienating customers or damaging quality through aggressive cost-cutting the greater threat? It's not always obvious.
That really does frame the strategic dilemma perfectly. It's a constant balancing act.
It is.
So, okay, let's try and synthesize. What does this all mean for the listener? We've basically identified 8 distinct, specific strategies a business can potentially use to maximize profit. 4 robust strategies on the revenue side: promotion, innovation, service, expansion.
Yep, the growth levers.
And then 4 highly flexible strategies on the variable cost side: suppliers, bulk buying, waste reduction,
The
utility.
efficiency levers.
Plus those 2 challenging, high-leverage fixed cost targets, rent and insurance.
That's the playbook, essentially.
Sure.
You now have the full strategic playbook for arguably the most important financial objective: profit maximization.
Right. There's always a but, isn't there?
Well, just context. We must place this objective, profit maximization, within the broader context that the source material itself provides.
Okay.
While maximizing profit is crucial, the documents we looked at, they explicitly mention a whole wider ecosystem of key terms.
Like what?
Things like overall aims, specific objectives, SMART goals, and importantly, the distinctions between financial and non-financial objectives, and even between private, public, and not-for-profit organizations.
So profit isn't the only thing, even if it's primary for many.
Exactly. Profit is just one objective, albeit often a dominant one, within a much larger system of business goals that managers are constantly trying to balance. It's complex.
Right. And that's the value here, hopefully.
Yeah.
You, the listener, now have this foundational understanding, condensed, clearly structured into those 2 primary levers: revenue and cost. It gives you an analytical framework, really, to assess almost any business's strategic decisions.
Hopefully so. And maybe leave you with a final provocative thought, something to chew on.
Go for it.
The source material explicitly notes that the very next topic after profit maximization is financial objectives, market share.
Ah, interesting juxtaposition.
It is. We focused entirely today on maximizing profit, which often means driving immediate cash flow or achieving maximum efficiency right now. So the question is, how does aiming for maximum profit, which can feel like a shorter-term cash metric, how does that balance or maybe even conflict with aiming for maximum market share.
Which feels more long-term. Exactly. Market share is more about long-term influence, scale, strategic positioning. You often can't perfectly maximize both at the exact same time. That tension, that's the strategic challenge of growth. Where do you place your bets?
That is a fascinating question, definitely something for our next deep dive, perhaps. Thank you for joining us today as we explore these levers of profitability. Keep exploring that relationship between profit, cost, revenue, and yeah, that broader world of non-financial objectives too.
Thanks to both of you for joining us today. You've been listening to the Business Gurus. Let's now hand it over to you. What further questions do you have based on what we've discussed so far? Leave a comment and we'll get back to you right away. If you haven't already, hit that follow for more business tips.